Hello and welcome to Property Box Weekly News with me, Simon Evison. Property Partner, a specialist broker who offers investors the chance to buy small shares in buy-to-let properties, has now launched a new service where returns are potentially boosted through the use of borrowing. Crucially, the full cost of the mortgage will be deductible from investors' profits, effectively escaping George Osborne's surprise new buy-to-let tax announced on July 8th. The firm has raised over £8.5 million from 4,000 investors since its launch 8 months ago. Each property is owned by a specially established company with shares issued to investors. Investors therefore stand to gain both from rental income and, if prices rise, from capital growth. The shares can be traded on the website with the idea that small investors can buy and sell relatively freely and build a portfolio of exposure to different property types. Rental income is returned to the investors in the form of dividends. The structure means the investments incur corporation tax rather than the personal taxes that would be due where an individual owns a buy-to-let directly. Perhaps most importantly, the company structure means the Chancellor's new landlord tax can be legitimately avoided. So far, all of Property Partner's purchases have been cash only. The introduction of mortgages adds risk, but in a rising market should result in significantly higher total returns. In a market where house prices fall, losses are exaggerated if a mortgage is in place. When prices rise, the mortgaged investor does far better than the cash buyer. But will it really work? Dan Gandesha, the broker's chief executive, said the structure had been developed and tested by lawyers. Other landlords are said to be thinking of similar manoeuvres designed to mitigate or avoid the tax. Those who already own properties through companies are unlikely to be affected by the proposed tax. Those who want to buy new properties through companies are also likely to escape the tax. Have you invested in this scheme? Let us know in the comments below. According to a new study, private sector rents have been falling in real terms. Research commissioned by the Greater London Housing Assembly's Housing Committee and carried out by the Cambridge Centre for Housing and Planning Research has confirmed that rents increased by less than inflation and average wage rises. It states private rents have actually risen below wages or CPI on average during the period 2006 to 2013. This is true both in London and in England as a whole. It also finds that 45% of landlords would sell up and leave the market if they were legally required to cut rents through council or government-inspired controls. This could potentially exacerbate the housing shortage. The revelations come at a time when accounting firm PwC is predicting that 25% of households in the UK would be privately renting by the year 2025. That's all from us this week. Thanks for tuning in. See you next time. When prices rise, the mortgage investor does far better than the cash buyer. But really, when prices rise, the mortgaged investor closes. Why did I say closes? It doesn't even say close. The idea that small investors can buy and sell. According to a new study, private sector rents have been not from the north. Property partner. The tip of the tongue, the top of the teeth. That didn't make sense.